Yeah, and the ARR are basically pure profits. Like it's on a net basis. You kind of don't pay it out. Okay, and the 17 bodies, it's like less than 5 million a year, I'm guessing. So you are like deeply profitable currently.
Correct. There is definitely a viral consumer product that will be built on mobile that combines some of these primitives for consumers in the next 5 years that has not yet been built. That's unequivocally going to happen, and we feel like we have perhaps the right ingredients to bring something like that to market in a differentiated way. But again, the success of mobile or trading is downstream of distribution. You have to have that distribution channel, or you have to have an insanely viral growth loop. So that's the real challenge. I don't think we're the cheapest, no. We do price on a premium basis relative to others. So I would say we're not the cheapest, but we're the most effective.
All right, we're live. Welcome to another episode of BidCast. I'm your host, Jason Kam, aka Maple Leaf Cap. Today is May 14th, 2025, 8 p.m. Hong Kong time. BidCast is being live streamed to BidClub members. Questions are from the members and my own. Today, I'm speaking with Brandon, the co-founder of Layer3. Brandon, welcome.
Yeah, thank you for having me. Excited to be here.
Yeah, I remember us talking like, I don't know, 3-4 years ago when you sourced me from Twitter, and then we just kind of like, I don't know, you were an investor back then, and you're now a founder, and I'm sort of, an investor running a fund. Really glad to be interviewing you and talking about L3, the token, and the company. We're gonna jump right into it. I guess here's a thorny question for you. I don't think your mindshare on Twitter is all that big for L3, the project. So how do you have 300K to 500K MAU today, and where do they come from?
Yeah, it is a great question. I would say mindshare wise, we probably could do a better job. The business itself has a pretty natural flywheel to it that took, I think, 1 year or 2 years to build, but it's no different than any traditional aggregator. And the flywheel essentially is that we're a two-sided marketplace. For those in the audience who maybe are a little bit less familiar, on one side you have protocols, so large layer 1 and layer 2 ecosystems, as well as hundreds of apps. On the other side, you have consumers that come to layer 3 for discovery. And so when we first started, it was very hard to get that flywheel spinning because you couldn't go to protocols and say, we'll help them acquire users if you didn't have consumers, and consumers didn't come to your platform because there was nothing to discover. Like there was no marketplace. It'd be akin to, Airbnb not having inventory. And so we just sold to anyone who would listen to us, primarily at the app level. And I basically just would pester these people and say, hey, like you should distribute your token through layer 3. We'll help you reach users and so forth. Ultimately, we got that flywheel spinning through just a lot of hustle. And now when a new ecosystem comes to layer 3, if it's a new layer 1 or layer 2, with that comes a whole new cohort of users. So as for instance, if we do something with Berachain, there's a whole cohort of consumers who want to explore the Berachain ecosystem that then come to layer 3 to discover and explore Berachain on our platform. Now, I'd say roughly 45% of those consumers will then stick around to go and do other things in the layer 3 ecosystem. So each time we have that sort of incremental ad on the B2B side of our marketplace, we're able to acquire new consumers. And that flywheel happens pretty organically. So while the core layer 3 footprint on social perhaps is not as significant as you're pointing out, what you have is each of these brands promoting their activations on layer 3, and then that helps us acquire a natural consumer footprint, and that flywheel is just constantly spinning in the background. So that's really how we think about it. And then I'll also note, just before I pause, is when we define our monthly active users, we're defining users as those that are transacting on the platform, so revenue generating users. So it is I think, an intellectually honest definition of the word, because I think a lot of people are just site visits or things like that.
Yeah, monthly active paying. I guess my question
Correct.
is more so towards like, who are they? Because they are definitely not loud on Twitter. It's almost a completely different segment of the market versus your typical, US-based or China-based 25-year-old aping, degen coins. Are they like Indians, Pakistani, Argentinians who just like have no job and they just click and just make money? Who are they?
Yeah, so I often say there's 3 types of consumers in this industry. The first is the consumer who has a profit motive through effort. So that's your play to earn gaming, airdrop farming, nowadays Kaido, things like that, where they're spending their time and their effort to express their profit motive. They more or less view themselves as gig workers on chain. Like instead of driving for Uber, they're just spending time clicking around on chain. This cohort, unfortunately, by I think the intellectual class has a bad rep, like they're lower quality users and so forth. But by and large, like most chains are built on the back of their work. Like most ecosystems are built on the back of their work. So that is one cohort. The second cohort is profit through capital. These are your traders. They're speculators. These are people spending time on pump fund, on hyperliquid. They're trading spot. They're trading perps. They tend to be higher LTV insofar as they're a higher wallet balance and you can generate higher fees from them. That has, I think, greater mindshare on crypto Twitter just because it's a higher, I think, value cohort and more people are competing for that share. And then your third is basically your consumer in the emerging market that doesn't care about crypto but benefits from access to basic financial rails. So our product serves right now the first. We have a number of bets aimed at serving the second, but that just gets less mindshare on crypto Twitter. I think they are like viewed to be a lower caste or class in like the hierarchy of status within this industry. But that doesn't mean that you can't build a really powerful business around them. It also doesn't mean that they're not valuable consumers. These people spend most of their days on chain. Again, they do view themselves as gig workers. So there's kind of an argument to be made for the fact that we know the marginal rate of like on-chain labor because of the fact that we serve all these ecosystems in a really interesting way. But no chain, I think, would be able to come to market without appealing to this segment. Very few apps would as well. And that's how I'd classify them. As far as geos, yeah, I think you're looking at more emerging markets, places where that time is really valuable, and the earnings that they can get from spending their time on chain, it is valuable to kind of the family's bottom line at the end of the month.
And their loyalty are more to you, I'm guessing, because they view you as a place to earn. They don't really give a shit about what protocols there are. They kind of just, money, like let me do these quests.
Yeah, exactly. Like I think it's someone who maybe makes a living by driving for Uber and also across like Uber and Uber Eats and so forth. Like they have a tremendous amount of loyalty to Layer3. I do think that certain times they discover things that they're super interested in. So like Eclipse is for instance right now. I think a lot of consumers have discovered the Eclipse ecosystem through us and are spending more time there. So that organically happens. But the other thing you have to bear in mind is like we try to take a really unopinionated view. So long as a protocol or ecosystem is audited and is like a usable product, we will try to serve them. But a lot of times those ecosystems or those apps, maybe they don't really have good utility or like the 10th DEX isn't that much better than, a Uniswap. So in those cases, the consumers might be a little bit more mercenary. They're coming to kind of like get paid to spend time on that DEX. But those teams don't mind it either, right? Because as you know, and as I think many people on the call know, like there are different games different teams are playing. Some are trying to get a listing, so they want their metrics to look good, or get a raise done, so they're trying to get their metrics to look good. And when I say that, I think sometimes people have allergic reactions, but that also exists everywhere else in software too, right? If a team raised the seed round, they're trying to get an A done, and they have called $500,000 in the bank, and they know that if they don't get this Series A done, they're probably going to go out of business. They're going to spend a lot of that through Facebook or Google Ads to get their metrics higher so that they can go out and fundraise. And so I think the same dynamic exists.
Yeah. It was extremely relevant, I guess, before this year, where your means of exit is to low float, high FDV exit through active market makers on Binance, let's say. I would imagine for protocols who needed on-chain transaction, especially layer 1s and layer 2s, like on-chain transaction, active users, active paying users, the dirty little secret is they sort of paid, like they got those numbers they wanted through you and a few other actors.
Yeah, I mean, pricing power in this industry is downstream of whoever can help you achieve your goals, right? So there are two goals teams have. One is generating a great business, and the other is generating, a good token, and a token is downstream of good listings and so forth. And, hopefully in the fullness of time, the good business is like the first prerequisite to a good token. But right now there's different games in the market being played. But anyways, you have pricing power if you can help them accomplish the like good business part. And that's where we sit, which is if they come to us and they say, I don't have users, help us get users, we can help them do so. But as I mentioned, the tooling and the infrastructure that we've built is intentionally unopinionated. So if they come to us and say, we want to generate revenue, we have the mechanic to target users who have higher wallet balances or fee spending, can get them to a positive ROI on their spend or positive ROAS. If they come to us and say, we just want as much transaction activity as possible, we can also do that. Where we draw the line is we don't help with like social or like Discord engagement or anything like that. That is just a really murky business, because if you try and help them get like a bunch of bots on Twitter, what you're going to end up happening is diluting the layer 3 user base to a point where it's pretty much unapproachable for anyone who wants to reach high quality users. And so we intentionally, for business reasons, don't serve that need.
And I guess for any protocols who need this kind of on-chain transactional throughput, are you pound for pound the cheapest solution out there?
I don't think we're the cheapest. No. We do price on a premium basis relative to others. So I would say we're not the cheapest, but we're the most effective.
You are the most effective because the transactions that came from you do not look like bots, and they are the highest fidelity data that they can present to exchanges, basically.
Yeah, I mean, if I had to point at it, there's probably 2 or 3 market misconceptions about our business. One of them is that they're bots. It comes back to the classifications I had mentioned earlier, which is these people are spending time with the profit motive. Like, no one wakes up and is like, I'm passionate about swapping on the 10th DEX on Avalanche, right? Like, that's just not a consumer that exists, no matter how much the founder wants to believe it. But they're real people with real wallet balances, and they have the propensity to I think, to stick around. And so we ran this analysis, it's a crude analysis, but basically we took like an aggregate score on the quality of the project based on how much funding they had, how many audits they had, and so forth. Because we were trying to isolate, if the project is high quality, will our consumer base retain organically within their base? And so for the top 25% of projects by this score, which again, it was somewhat subjective, but it was how much they had raised, how long they had been around, and so forth, 60% of the consumers that we brought to them retain organically. So if the project is high quality, the consumers we bring will retain. But there's also a long tail of low quality projects that, like, we can't promise that our consumer base will retain because, again, no one wants to spend time on that DEX.
That's cool. And then you made $20 million of ARR last year?
Roughly. I mean, last year, the public numbers was 16 million. We closed the year on a run rate basis of 20, but all in, we booked 16.
Got it.
Profitable since Q1 of last year.
Can you break that down? How many accounts that is that contribute to that 16 to 20? And then how does that's the cash flow. How does that flow down to your actual profit number?
Yeah, so we make money in three ways, but I'll simplify it and just say there's B2B revenue and B2C revenue. So B2B revenue, protocols pay Layer3 in some form to distribute their token or reach users through our business. There's a huge range in the way that we price those because some teams are pre-token, some are post-token, some are going through TGE. So, sometimes we're getting percentage of total allocation, sometimes they're paying more of a SaaS fee, things like that. But that is a part of our business, and over the history, probably 50% of our revenue comes from B2B. Then there's B2C. So B2C, you have trading fees. We have Bridge and Swap natively built on top of Socket and Li-Fi, where we take a fee. Naturally fits into our product because consumers are spending time across 40 chains and 500 apps, so they want to move assets around. And then we have what's known as a credential fee. So users spend 25 cents every time they complete an activation. They spend that fee because of the downstream earning potential that they get from it. It's basically just like their ticket to earn on Layer3. That also, on the B2C side, is about 50% of our revenue. On the protocols that we serve, so we have about 40 chains that we're live on. Not all of those chains are paying customers, but we serve them. And then above that, you have probably 500 to 600 different apps, most of which are paying. And the contract sizes really range. I basically segment this no different than how you'd segment an enterprise software. So you have kind of your large enterprise, which are the chains. You're typically looking at high 6, low 7-figure contracts. You've got your medium-sized enterprise, which is I'd say your larger blue chip apps. So your Compounds of the world, your Avies of the world, there you're typically looking at higher 6 figures. And then you've got your long tail of seed to Series A audited apps. There you're looking at closer to 5-figure contracts. And then on the how that flows through to our bottom line, I mean, look, we are a 17-person team, so it doesn't take a lot to run this business. We're not operating a chain, so our infra costs are relatively low. So we do, I think, maintain a pretty healthy margin. How we think about that profit, we had put on an experimental buyback for the past 2 quarters that we plan to pause. I think our thesis is no different than traditional capital allocation. We feel we're still early enough and growing fast enough that we want to continue to reinvest into organic growth. But at some point, we would explore buybacks.
Yeah, and ARR are basically pure profits. It's on a net basis. You kind of don't pay
Correct.
it out. Okay, and then 17 bodies. It's less than 5 million a year, I'm guessing. So you are deeply, deeply profitable currently.
Correct.
Okay. That's great. And therefore, you don't need to ever sell your token to fund yourself, I'm guessing.
Correct. We don't need to do any type of like fundraise for cash needs. We do find value in having investors. A lot of our business has come from referrals. And so if there's an investor that we think brings geographic presence or has an interesting portfolio that we can cross-sell into, we will obviously find a way to work with them.
Got it. And then the profit now rolls into a treasury. And does it accrue to equity? You dividend it out, or you're retaining it for growth, and in the future it'll accrue to the token? How do you think?
The latter. Yeah, the latter. Value will accrue to the token in all cases. For like regulatory purposes, there's an equity entity, but there's no value that's accruing to it. And we, the basic premise is like, we had experimented with buybacks, but I think we're 3.5 years into our journey. And if you asked, name a marketplace that was 3.5 years old, whether or not they wanted to do buybacks or reinvest in growth, they would say reinvest in growth. Marketplaces are businesses of network effects. And I think that our point of view is that if we can continue to maintain kind of a healthy financial profile, why not continue to reinvest that into growth in a way that's organic? We have explored inorganic, but to be honest, I think we're not at the scale yet where we can do acquisitions that I think are accretive. So it would be something we'd explore downstream.
I mean, you should have a pretty sizable treasury at this point then. Is it like 10, 20, $30 million type of treasury that you have?
Between 20 and 30.
Okay, great. Well, congrats. It's good business, it seems like. But
yeah. Thank you.
To push the line of thought a little further, and then we'll get into the exciting part in a second. It would seem like your cash flow comes from a factor of VC funding to projects, and the projects who need a higher valuation for whatever reason, for fundraising, for exits, and whatever. And then your business is a tick rate on that. Given what we're seeing in the changes in the private market and how these companies trade at, do you feel good about this year's ARR continuously growing, or do you feel like it'll be a tough comp this year versus last year?
So the heuristic in private venture markets over the past 20 years, and this is hard to substantiate, is that 40 cents on every dollar raised went to a Facebook or Google ads. That's like the number that's kind of often thrown around. Our worldview is that probably you want to handicap that a little bit, but call it 20 to 30 cents of the treasury of most projects will go towards growth in some capacity, and growth in the history of the internet always goes to the most efficient distribution channel. So if we can prove to be efficient, then why would we not be able to capture that? So I think we're going to continue to see spend there. As for expansion, look, for better or for worse, the industry has created a pretty interesting incentive, which you know well and is talked about on Twitter, around the funding of new chains. And in order to launch a new chain, you do need a lot of capital. And so long as that continues to exist, I think we're going to continue to see expansion on the B2B side, because these chains are increasingly competitive with one another. They need mindshare, they need users, they need transaction activity, and we're one of the more efficient places for them to spend that money. So that trade in and of itself as a macro trend is great for business. For any aggregator, I think the strength of your product is how many consumers you have. So aggregation theory is this term Ben Thompson from Stratechery had popularized, and I think probably most on the call are familiar with it. But the basic premise is that you're aggregating the supply side of a given market. So Amazon aggregating e-commerce, Netflix aggregating content. You own a distribution channel or are leasing one, but you have a direct relationship with the consumer, and you can achieve economies of scale and capture a lot of value in doing so. But all of those businesses, the strength of their business is downstream of how many consumers they actually own. And so the way we think about our North Star business expansion is owning more types of consumers. So I had mentioned those 3 cohorts. We kind of own the profit for effort. If we can continuously own the profit for capital, that's great for us, because then we can go and serve a lot of these products that want to reach those consumers, and we can get them users who have wallet balances maybe close to 1 million or 2 million in size. So figuring out creative ways to serve that cohort as well as the first cohort is how we think about expansion, because it just gives us more pricing power. And you're seeing this today, right? Like Binance or all the exchanges like that. I'd argue that they have probably the best pricing power in the industry, because teams will pay upwards of $10 million to get that distribution. So that's hopefully how we can go about growing.
I guess a part of your business growth would come from just signing on new customers who need metrics, and most of them are layer 1s and layer 2s.
Correct.
Do the propensity to spend from a customer increase or decrease after the TGE?
On a number basis of customers, I would say it decreases. On a dollar basis, it increases. So you see increased spend from Optimism, Arbitrum, Base, right? Like we've served those ecosystems now for many years. And we've been able to, I think, acquire more revenue per period from those teams. So higher quality ones, they're growing, they have healthy treasury management. You're also selling into a really sophisticated buyer. A lot of these teams hire people who understand how to measure ROAS and things like that. But then you've got this long tail where like I'm selling into a founder. The founder raised, call it $20 million for some new chain from a group of investors that, you know, maybe many on this call probably don't really respect. And then that's like a less sophisticated buyer. They're just trying to like juice their numbers. And then they don't do anything. Like their chain doesn't really exist. They don't really build it. Like they're just playing this trade that's existing in the market. So they're a little bit harder to, I think, retain on a like a number basis, but the dollar basis continues to expand because the higher quality ones spend more, if that makes sense.
Yes. So those scam projects churn off, but they pay you a lot of money, and they're like kind of dumb. And the good customers, like you have a higher tick rate over time. Just wallet share expands because
again, that's where like our business is similar to a Binance, and I'm not like comparing the two profiles. I don't want to come across as ignorant. Binance is in a world of their own, but at the same time, like what happens is you have certain projects that come to these exchanges, and you have such significant pricing power because they're insensitive on the cost. They just want to get through this period. In there, you can capture a lot of revenue, and you're always going to have a supply of those projects because of the way venture funding works. But then there are ones that are lifetime customers. And if you were to look at Facebook's customer base over time, I imagine you'd have something very similar. There are a lot of venture-backed companies that have spent on a Facebook or Google ads that ultimately went out of business but contributed to Facebook's top line. But then the ones that retain over time, the Nikes, the Coca-Colas, those are large parts of their advertising revenue.
So the revenue from scam projects, from new L1, L2 launches, and the existing customers kind of taking up their wallet share, do you feel like that's a significant source of growth for this year? Or would you sort of bet a higher growth trajectory from, let's say, the second bucket of users, which is accessing the higher value group that is in CT?
The latter. I mean, I think, but hopefully the efficiency of markets is that we get just a higher quality customer base that sustains over time. They continue to grow their spend over time. We attract larger and higher quality consumers, different types of consumers. That would be the direction I want our business to go. I think it's healthier. We're selling into a more mature buyer set, a higher quality buyer set. If all of a sudden, macro, let's say rates go to zero, capital goes out in the risk curve, LPs fund venture firms start plowing money into these types of businesses. We still are net beneficial. But that adds some cyclicality. Like you're going to see a spike and then you're going to see a trough. Whereas I'd prefer that we grow our marketplace with customers that can grow with us.
And then of the user base who are sort of more pronounced in CT and do have more capital, what's the effort to kind of grab them, which hasn't been in focus in the past?
It used to be. Sorry, are you talking on the consumer side or the B2B side?
Consumer side. So
on the consumer side,
are actually clicking and doing
yeah.
Side.
So we haven't spoken too much about this yet, but I think in when it comes to crypto, consumers really resonate with specific brands, and oftentimes brands are relatively baked. If I were to go to most people in the industry and ask them what they think about Layer 3, I think they'd have a predefined opinion on it, and I think many consumers as well. And so our worldview is that if we want to reach some of these consumers, we might need new brands to do so, and we might need new surfaces, be it on mobile or more of like a trading style interface. But a user who has, call it, a wallet balance of 1 to 2 million is going to interact with a different UX and a different brand than a wallet balance of 10,000. And so that's how we're going to go about reaching them. That's the current strategy, is to kind of build new brands under the broader Layer 3 umbrella. The analogy would be, and this exists in the internet, right? Like, there's a certain consumer for Instagram. There's a certain consumer for the Blue app on Facebook. There's a certain consumer, if you look at a business like IAC that goes to Expedia or Match, there's all these different types of brands that resonate with different consumers, but accrue to the same parent equity, and that's our parent token in our case, and that's how we would think about it.
Hold that thought, because we'll get right into it. But before that effort takes place, do you have a target for what your ARR looks like, excluding that effort, for this year or next year?
I'd like to double. I mean, I think we could expand our revenue base in our current business to double. So that would put us around the 30 million mark. We've got some work to do on that, just based on kind of the year so far. But one of the things is, we've gotten the marketplace to a point where if we can expand, if we add a new salesperson, that person can get to kind of like a 3x on their cost, which is the rough rule of thumb for enterprise software, pretty quickly. So in probably 60 days, a salesperson on the Layer 3 team can basically pay themselves 3 times over. And that is where I think we're going to reinvest, is just adding more bodies to serve more ecosystems to hopefully get the flywheel spinning.
Very helpful. Tell me about this ICI multi-enterprise subsidiary effort, and what's the most exciting thing right now on that front?
Yeah, I mean, I think we're still trying to keep some of this close to the chest, but I will say that if anyone in the audience is familiar with like what Barry Diller built at IAC, I think it's an interesting model. And the way the model worked was you've got basically a parent company that creates new brands, Expedia, Match.com, et cetera. Those new brands reach new audiences and get to a point of maturity, and then they spin. And when they spin, in the case of IAC, the IAC shareholders basically get a claim on the stock that's spun out. So it ends up being extremely accretive for stockholders. I think that no one has tried to do this in crypto for a few reasons. One, I think that a lot of time and capital and attention has gone to infra. So there just hasn't been that much human capital that's been thrown at consumer in an interesting way. Two, I think there's less sophistication on the capital markets and being able to tell the story to the capital markets. Like, I think a lot of people immediately think grift when they hear of multiple tokens, but you could do it in a way that's unified and like in the true spirit of how like equity markets or capital markets work. And then the third is, I think that people understand this theory of consumers resonate with different brands, but they haven't tried to do it with like one unified distribution footprint, which is how we're trying to do it, and one shared infrastructure, one shared data layer, because we have a tremendous amount of data on all consumers in this industry. And so that's how we're thinking about it. I think, time will tell whether or not the strategy proves successful. IAC obviously did it at much greater scale, thousands of employees, much more mature business, greater balance sheet, and so forth. But I think if we do it the way we aspire to do it, we can pull it off in a really accretive way. And that accretive way would be valuable to token holders, right? Because if you are a token holder, you get a claim on any spin. If the asset's not spun and there's no new token issuance, then the cash flow automatically accrues anyways.
It's obviously early days, but when you do it, would it be similar to the equities market where you just get the airdrop and nothing is retained to, well, I guess if management is a token holder as well, you get the same thing. But there will be no
That's
ICO,
correct.
There will be like nothing. You just boop, get the token.
Correct. Yeah, it'd be so like nothing is retained by the company, right? But in theory, you have all investors and all team who are holders of the token, so that they're benefiting as well. But then in theory, you'd also have all retail. There are some nuances that you'd want to solve for, right? Which is like I think equity markets are a little bit more mature, and you have more entrenched shareholder base, and you also have less churn in your shareholder base than your average token holder base. And so to solve for that, you could have some type of like claim period. So Athena has done this, I think, really well, where you get like your vested Athena. And I think it'd be something similar where you kind of get like a vest. And if you sell your parent token, then you basically forfeit that vest in some capacity. But we need to think through like the true structure. We're many years away from there being like a spin on a token, but the concept would be divide to compound. I think that's like an interesting model and has worked really well for something like an IAC or even a Liberty Media.
For sure. Can you share anything about what you're trying to build, or at least if you cannot, then the sort of lanes that you're trying to pick on what you want to build there?
There's 2 lanes, trading and asset issuance. I think those are the 2 largest markets that you can reach new consumers in. Asset issuance has like such a wide range in this industry. So how we would approach it would be something that's hopefully net new and interesting from a consumer's point of view on asset issuance. And then on trading, it's kind of your usual. I think where we believe there's a gap in the market, despite there being many teams attempting to do this, is a truly unique mobile experience that combines a lot of the primitives we've seen over the past few years. So spot, perps, prediction markets, things that really appeal to the cohort of consumers, both in crypto that like those features, and then also outside of crypto, the consumers who really like kind of the intersection of equity markets and sports betting. I think there's a gap, at least we believe there's a gap to serve that market. And in doing so, you can capture an extremely high LTV base.
And sorry, and I guess on the trading side, we can start with that one first, which is a mobile experience that aggregates some of the most interesting betting that you can do, which is meme coins, central exchange coins, and then prediction markets all into one. And is it going to be like do you feel like it will be necessarily entertaining based, like kind of live streaming Robinhood like, or do you think it'll be more serious?
The latter.
To
I mean, I'm sorry, the
extent you can
former.
Talk about it, yeah.
Yeah, the former. I mean, look, I think that there's just many on the call know this, right? You've got a huge trend in demographics where I think Gen Z is suddenly entering the workforce. You have a massive amount of wealth transfer from kind of like the boomer or like millennial generation down to that cohort. They like internet native experiences. The percentage of people who are participating in sports betting is increasing. The percentage of people who are flying to Vegas to kind of scratch their speculative itch is decreasing. So all this is kind of coming online. I think there's a lot of interesting primitives that have come to market over the past 2 to 3 years. You now have really interesting trading experiences on Hyperliquid. You've got prediction markets that I think are in full swing. More consumers are familiar with things like parlays and how you can go about participating in sports betting. And so there is definitely a viral consumer product that will be built on mobile that combines some of these primitives for consumers in the next 5 years that has not yet been built. That's unequivocally going to happen. And we feel like we have perhaps the right ingredients to bring something like that to market in a differentiated way. But again, the success of mobile or trading is downstream of distribution. You have to have that distribution channel, or you have to have an insanely viral growth loop. So that's the real challenge. It's not necessarily building the product. Like, you could probably build a product that brings all those things together in maybe 6 months with a group of really talented engineers, but getting that product into the hands of users is the real challenge. And so there too, we have a few unique ideas on distribution, but time will tell and whether or not we can reach the audience we want.
Got it. How much money do you plan to spend on this?
So you could, returning to the IC point, you could potentially create subsidiaries and source capital from financing, which we may do. Balance sheet is still strong, so you can invest in that. I think from an R&D perspective, you're probably looking at somewhere between 2 to 3 million per bet as a cap, but likely less before you know whether or not it's working.
Got it. Do you feel like L3 stakeholders could kind of participate as a part of this? Like basically bring in L3 stakeholder as external funding?
If we were to do something like that, we could probably tap into Echo or Legion in some capacity, where maybe we do something custom. I'd have to explore it. Maybe we do something custom where, like, if you're an L3 token holder, you get like a right of first refusal to participate in the financing, or you get early access, something like that. It's an interesting thought, but we'd have to probably do a little bit more work on it.
And I'm guessing 2 to 3 million for just the product, but the marketing costs extra, like a lot more.
Well, if you're trying to bring a mobile product to market, yeah. So then there again, like, you could potentially come up with some interesting financing structures where if you prove that the product is revenue generating, you can perhaps finance some of the advertising spend through like a claim on cash flow, which you see in traditional like software markets as well. So there's interesting sourcing of capital that I think we would explore if we can get a product to kind of a revenue generating state. But getting the product built, yeah, you're looking at somewhere, I'd say, around that range, likely less. I mean, the infra to build a mobile product today, like I said, you can get that done in maybe 6 months with a group of talented engineers, and it's not going to cost you that much. But then, yeah, advertising spend is where the bulk of your cost will be.
Got it. So how far in are you, and should we expect this by, say, Thanksgiving or Christmas, based on that timeline?
Thanksgiving and Christmas, yes. How far? I think we've been thinking about this for maybe 5 months.
Been thinking about it, but haven't started building.
I think we've maybe laid some groundwork for it.
Got it.
But again, we want to keep most of this a little bit closer to our chest.
Got it. I try to skirt around whatever you're saying, as you can probably tell. So that's trading. And then asset issuance, I'm guessing it's a bit more preliminary versus what we just talked about.
Correct. I think that we've concluded it's a big market, and I think that we've also done some market mapping on what has worked, what hasn't, across the trends. Asset issuance as a category, like, means many things to many people. It could mean, what you're seeing with Pump or like Believe. It also could mean, Tether and Circle, right? So like I think we are market mapping what's working, what's not, and believe there might be something compelling within consumer, but time will tell.
Got it. So I guess it's one bet at a time for now, and trading is the first bet. Okay, got it.
Yeah, I mean, like the cardinal sin for any startup is focus, right? So if we say, look at us, we're 4 years into our business with 17 people, we're going to be the next IAC. That would be the kiss of death. I think we want to do it thoughtfully, where we can, find adjacent lanes that we can allocate resources, bring people in to explore those ideas without it cannibalizing or distracting what we have right now, which is a pretty good business.
In a sense, you're not investing, just to be clear. You're incubating them. You even staff internal management teams into these businesses and spin them off.
Exactly.
Got it. So we talked about two things. I think these are cool. I think the ICI spin model makes a lot of sense. It's interesting. Anything else that is on your mind that's gets you juiced? Are you buying other things? Or what else?
I mean, like I said, we would be interested in inorganic growth if something compelling came. So one thing that we had taken a look at was there's like a whole new cohort of stake style competitors. So again, this is something that I think crypto Twitter maybe has an allergy to talking to, in part because many of these aren't venture backed, but a lot of these like crypto enabled casinos throw off a lot of cash, not stake level cash, but they throw off a lot of cash. And so that could be really interesting. So we've looked at some of them. So I was in Dubai 2 weeks ago and I spent kind of a full day with one of those teams. Nothing has really quite clicked from just an alignment perspective. You have, as many on the call probably know, like you have kind of like this house balance sheet that you have to manage. You got to manage your risk. But if you can get those parameters correct, then it just becomes a game of growth. How do you go about acquiring new consumers through advertising spend? And that would be a game that I think we could potentially play. But again, it's one thing at a time. But inorganic growth, that would be an interesting area because you're acquiring a large consumer base and you're also acquiring a business that is profitable and an engine. And there are a lot of management teams that are building those types of businesses that might not want to be in them for a long time. So that's one area. And then the second is within our core business, I mean, there's just a tremendous amount of work that we can do around optimizing the distribution, right? So today, if you are a protocol and you show up to Layer3, you get access to this kind of no-code builder. It's similar to like a Facebook Ads Manager, where you predefine your set of criteria and you load your budget and so forth. That can always be optimized. How do you reach the right consumer at the right time? What's the right reward profile to get what you want out? And so, and like that's an engine that we've kind of already built and is always kind of humming in the background, is constantly optimizing that. But I think there's room for us to continue to focus on that and continue to expand how much we're selling into the B2B side of like the core business.
I see. So just to summarize what we talked about, which is as long as the space is L1 and L1 growth and VC funding, hopefully you'll double that business this year, maybe not double, but like 30 million, just about. And then with optimization, more customers, increase the tick rate and wallet share. And then off your treasury, you're probably going to spend some dollars in funding one this year and maybe two both combined next year of these efforts, which could come in a token airdrop spin fashion to token holders. And those could be worth, depending on success, a lot of money. Am I missing anything?
No. The inorganic piece. But again, like that would be...
Yeah, but it doesn't seem like you're like too seriously looking into it.
I think that's a lower probability. Like there's enough like focus again, right? I think in this conversation, I perhaps have maybe not accurately represented. We have a tremendous amount of focus on how much we can optimize our current business, right? Like if you can get something with our cost structure to where it is in profitability, in 3 years, there's certainly room to expand that. And so that does require just a lot of time, effort, and focus. And if we can pull that off and continue to grow that while also perhaps exploring one of these adjacent areas, that would be a successful 18 months for us.
Last question I have before I open up to the group, which is, after Trump, how does your view on the value accrual model for your token changed? Let's say there is a time where you sort of run out of options to grow, optimize. You run out of options. You kind of already funded the things you want to fund, and you still have this huge cash pile. After Trump, what do you think is the best way to play with that level of cash?
I mean, I think before and after Trump, our worldview was always that capital allocation is like a studied practice, that there's many, many, many years of research on how to go about doing it. And there's many, many, many years of research on who's done it well. There's a great book, which I imagine you, Jason, have read, called The Outsiders, that talks about capital allocation across 8 of the greatest CEOs. Yeah, so look, I mean, there's a few things you can do with a balance sheet, right? You can invest in organic growth, so you can reinvest in product, reinvest in growing the team, and so forth. You have inorganic growth, so that's M&A. Returning value to shareholders or token holders through buybacks or dividends. Dividends make less sense in the concept of crypto because it's kind of like a staking claim or yield, and that's not, from a tax perspective, very efficient. So it'd be some type of a buyback.
And you feel comfortable. You feel comfortable with that.
Yeah, I mean, I think that we've gotten to a point where there's enough precedent for teams with our entity structure to do some form of a disclosed buyback. There's all sorts of like disclosures that you need. We should talk about disclosures as like a separate point because I've got some thoughts on that. But yeah, there's disclosures you need to make. But yeah, I think that's certainly a path once you reach maturity. I think the problem is that with crypto, you have a relatively unsophisticated token holder base, less sophisticated than even, I think, retail equity holders. And so they're like, when buyback, when burn, things like that. And that is not good from, I think, a capital allocation perspective. If you're 3 years into your journey and growing, why would you do buybacks? And then the fourth thing is like retiring debt. We don't have any debt, so we don't need to worry about that right now. But that's like your menu. There's obviously many other things you can do, but that's like broadly the menu of capital allocation. So right now it's just for us organic growth. Downstream, yeah, I think properly disclosed buybacks would certainly be something we're open to.
Mm. And when you say closure, what do you mean?
I just think so much of the like problems right now on the timeline are around just inadequate disclosures, right? Like, and I don't think it's going to come from the SEC. I think if we wait for the SEC in the United States to come up with disclosures, that's not going to be the path. In part because if you think about like the growth and the maturity of the U.S. equity markets, you know, you had this whole period where like there were no disclosures, teams could do whatever they wanted. It was actually very similar to how token markets have currently kind of worked. But then when the SEC came out, the reason that a lot of companies adhere to it was because on the other side of those disclosures were the deepest and most liquid capital markets anywhere in the world. But that's not how crypto works, right? Like you have deep liquid markets globally. And so if you have to go through the SEC, that's just like handicapping the team. You're not getting anything in return. So I do think the disclosures need to be downstream of the liquidity venues, which are primarily the exchanges. And I think there's basic disclosures that should be put out. I think there's like all the team unlocks. I think OTC sales, all those things I think should be managed by the team. I also think there should be investor disclosures. So similar to like your 13Ds, any like above a certain percentage, when an investor holds it, they have to disclose their holdings on a maybe a periodic basis. That would massively help the market. And I think it would also attract flows from more institutional buyers.
Yeah, I suppose the kicker there is they have to be rewarded for those efforts in a sense of higher valuation and better ways of funding. It may not happen.
Yeah,
I don't know.
Well, it's a classic like Silicon Valley meme, right? Which is a lot of these businesses, you know, there's no economic incentive. Camera's a little out of focus, but there's no economic incentive for them to do that, and that's kind of the core problem, which is like when you remove sort of the meme from Silicon Valley, when you remove the incentive to produce revenue, then more teams are not going to try not produce revenue because they're just going to play that fundraising game. And the question is whether or not we can get liquid capital markets in crypto to a point where the economic interests are aligned with disclosures.
Would you guys have an investor relations portal on your site?
We have a data room that I make available to pretty much anyone who asks. Candidly, I want to. That's just like 17-person team. But yeah, I want to do kind of quarterly investor relations calls and have all of this be super transparent. And it's something that we're working on.
Cool. I don't have any questions. Is there anything we haven't covered yet, Brandon, that you wanted to say before wrap up?
Before wrap up? No, I thought this was a great conversation. And yeah, I mean, I think it's interesting because our journey started 4 years ago before you had even, I think, started what you're doing now at Folius. And it's been it's been an interesting ride to watch the markets evolve, but I do think that despite some of the cynicism on crypto Twitter, we are like getting to a point where there's more maturity around liquid markets. I think what you're doing, even with these conversations, is like a step in the right direction. So thank you for having me, and great conversation.
Yeah. Thanks for your time.
Cool.
Okay.